Hi, welcome to the Market Alert for Tuesday, the 9th of May 2017. So, Macron wins, which we all know is old news. Market gapped up above the resistance, as you will see here. Whoops, wrong one. Let me just get the right one. So we see the market gap up there above the 21,045. Market couldn't hold against the 76%, and we see prices move lower. Now, yesterday has to be one of the quietest days I think I've ever seen on the Dow. We had a total of 47 points from the low to the high in the session. We also had 1, 2, 3, 4, 5 unfilled trades as well, because it was that quiet, no momentum. And as I've said before, I'd rather have no trade than a losing trade because of the lack of momentum. It's fine by me. I can wait until the volatility kicks in, and the volatility is the issue. We've got a situation at the moment where it is making new lows, and that's what I want to focus on here. If we look at the zero hedge page from yesterday, we've got VIX. The VIX crashes to a 9-handle, lowest level since Feb of 2007, which is what I've been going on about. It's getting unerringly quiet, and it's like the calm before the storm. It's like a tsunami where the waters ebb before the waves come crashing in, and this is where we are with this, unless the only thing that will stop it is if the central banks keep going in and buying. But central banks do eventually give in, as we've seen throughout the years. These lows in volatility will come to an end. There's no doubts about it. As night follows day, this will be the same case, and everybody's saying, oh, it's different this time, but it's not different at all. It's exactly the same as it was in 2008, in 2000, in 1999 for the Nasdaq, in 98 for long-term capital. It's called complacency, and everybody thinks everything's fine, but there are cycles, and those cycles, no matter how long they try and protract a recession, it still always turns up. And it's nearly 10 years now. I think next year will be the longest on record without some sort of recession. Not to be the prophet of doom, it's just the way the business cycles work. And don't forget, this is a funded recovery, central bank funded recovery to the tune of $4 trillion for the US Federal Reserve. So it's not really a recovery anyway, it's a manufactured recovery because of the problems that are in the debt market, the derivatives markets and everything else. This is super levitation that we're seeing here. And also, if we just go back a page, Citi also have a risk index. In this article here, Citi warns of volatility surge as its macro risk index crashes near record lows. And I'm just going to make this a bit larger so you can see it. And once again, you've got this situation where 2007, and look where we are on this sort of risk indicator. So again, some more compelling evidence there that things aren't too good out in the market there. And also, I think there's one more article that I saw. It seems to be dominating now. This is something I followed since 1994, and it's interesting now that it seems to be making headlines. Somewhere here there was an article from Goldman, another one there. US equity markets most euphoric in 23 years despite commodity carnage. Yes, the metals have been pounded as of all the other commodities. Again, doesn't make sense at all. Let's just go back another page. There's certainly an article because I've looked at it. It's just a matter of being able to find it when you want it. It's never there. I should put them on separate tabs really, and then we must be on the main page then. Here's another one as well. This is former Fed governor The last time I saw such uniformity of opinion was just before the crash of 2007. And here's the Goldman article. The last time correlations were this low was just before the financial crash, and what they're looking at there, I think, is the City chart that we've just looked at. Let's just see if it is the same one. It looks like it. Yeah, it is indeed, with a bit more added on, a few more bells and whistles there to highlight the risk. So you can see there's a theme here, whether it's because they know there's a crash coming and they want to say, well, I was right, I knew it was going to crash, I don't know, but certainly all of the data is adding up for a potential crash of the stock market. But as I say, it comes with this one caveat, and that is if the central banks want to continue to buy, the plunge protection team continue to buy, and they continue to push the VIX, which we see here, down to these lows. This is the lowest on the VIX since 2007, 9.77. So if they want to continue this down to zero, that's fine by me, because if we ever got down that low, which would be highly improbable, but you just never know with the insanity in these markets these days. But even if we went down to 5, the risk reward for shorting the market goes up hugely, because there's no way, there's just simply no way in physics or anything else. Eventually these things have to break. It's as simple as that. It can't continue when the economy, the data is starting to look poor. The Federal Reserve are doing whatever they can to increase interest rates so that they can then reduce them when this lot hits the fan, because at the moment they've got nothing other than printing money to support the economy. As I said earlier, paid for economy. They can't print without they've got a reason, and they need to reduce interest rates. That's why they've been increasing them. They haven't been increasing them because the data supports it. You know, it's been a case of 7 years without moving interest rates when they should have never changed them in the first place, and we should have had the crash of all crashes over and done with at that point, and now things would have been sorted. It was just delayed, and it's going to be the mother of all problems when it does start to fall apart. And finally, let's have a look at the implied volatility, this too making a new low as well. So the implied volatility putting in an 8, whoops, just grab that, that's what I was after, 8.13 for yesterday, because the market was so quiet there. Again, at the moment, the market is really quiet on the overnight market. So again, it's Tuesday. Let's have a look, see what news is out. That will give us a clue. Let's just see what news we've got out today. Absolutely nothing to shout about at all here. No, nothing from the US, apart from Kaplan speaking tonight. Oh, and the jobs opening at 3 PM, but that's actually forecast lower than the previous as well. So again, we'll just have to wait and see. So again, when you get down to these levels, you know that the odds are you're going to end up with a losing trade, and if you know that, then you have to take a pragmatic view and say, well, you know, I'll sit on my hands. And I've said to one or two people that I've spoken to in the last few weeks, in the days when we didn't have the internet and we had to phone the brokers, and my first broker was based in Ojai in California, and we used to have this saying, if you had the temptation to want to get into the markets and it wasn't quite right, then the best thing you could do was open the drawer, put your dialing finger in and slam it. Unlike now, where the temptation is you can just click the buy and sell ticket. In those days you had to phone and speak to somebody in order to get the order put through to the trading floor. So there was always, you had time to think about it, whereas now the temptation is easy just to go in. But when you look at the backdrop of how things are at the moment, the best thing to do is sometimes just stand aside and wait, and that's part of the psychology of trading. Right, that's it. I will speak to you later if anything happens. Other than that, as ever, thanks for watching. I'll see you in the next one.